Hey, welcome back. It's Jason Walter here. The share of loans in forbearance dropped below 5% for the first time in 1 year. And in total, the number of active forbearance plans decreased by 134,000 over the last month, which is a 5% reduction. This monthly decline is the strongest rate of improvement since late November 2020. In other news, the CDC announced today that they will extend the national eviction ban through June 30th. I have a lot to share in today's video, including an update regarding mortgage interest rates, which I'll share at the end of this video. And before we dive into the video, please hit the like button. I greatly appreciate that. That helps support the channel. And also consider subscribing as well, because I post videos about how this pandemic is affecting our housing market. Okay, thank you so much for doing that, and let's go ahead and dive right into the video. So the MBA, or the Mortgage Bankers Association, announced today that the share of loans in forbearance decreased to 4.96%. This is down from the peak that was set in May last year, when 9.0% of all loans were in forbearance, which at that time equated to almost 4.8 million loans in forbearance. And according to the MBA, the current number of people in forbearance dropped to 2.5 million in the United States. What I also found very interesting in the report is how the share of homeowners in forbearance varied by investor type. For example, the share of Fannie Mae and Freddie Mac loans in forbearance decreased to 2.77% from the prior week. In other words, only about 3 out of 100 Fannie or Freddie loans are currently in forbearance. However, the share of Ginnie Mae loans, which are FHA and VA loans, in forbearance is currently at 6.83%. This is more than 2 times more than Fannie Mae and Freddie Mac loans in forbearance. So why is this, right? So Fannie Mae and Freddie Mac loans tend to be conventional loans. And this is when home buyers buy a house with at least 5% down and often at least 20% down to avoid mortgage insurance. On the other hand, VA loans do not require a down payment. It's 0% down. And these are for our current and retired armed service members. On the other hand, FHA loans have a 3.5% down payment requirement. These are loans that are really popular with first-time home buyers who may not have the funds for a conventional loan and may not have the credit score needed to get a conventional loan as well. Therefore, it seems on average that those with an FHA or a VA loan seem to be more affected by this pandemic than others because their forbearance numbers are so much higher. Another thing that I found concerning in this report from the MBA is that the share of portfolio and private label securities loans in forbearance is currently 8.9%. This is more than 3 times the rate of loans backed by Fannie or Freddie, which are federally backed mortgages. I wish they would tell us how many loans this 8.9% figure actually represents. And this is because I believe these are homeowners who are not protected under the CARES Act that was passed 1 year ago. This is because the CARES Act only protects homeowners who have a federally backed mortgage. In other words, these loan servicers for non-federally backed mortgages may not offer all the options available for those who do have a federally backed mortgage once their forbearance plan ends. For example, these loan servicers of non-federally backed mortgages may require these homeowners who exit their forbearance to pay all their missed payments in one lump sum. If this is true, these are folks who are at greatest risk of foreclosure if they don't have enough equity in their houses or the funds to pay back all their missed payments once their forbearance plan ends. And if I'm missing something here, then please comment below. Meanwhile, going back to this report from the Mortgage Bankers Association, of the homeowners in forbearance, 83% are in a forbearance extension. So it goes to show how many people have opted to extend their forbearance plan. And remember, you can do a forbearance for potentially up to 18 months thanks to some extensions that were announced recently. What I also thought was very interesting in the report here was out of the total number of people ending their forbearance for the period from June 1st, 2020 through March 21st, 2021, almost 27% continue to make their monthly payments during their forbearance period, even though they didn't have to. In addition, about 27% resulted in a loan deferral or a partial claim. And this is when missed payments are added to the loan balance, but the homeowner's mortgage payments remain the same before they entered into a forbearance plan. In addition, about 15% resulted in reinstatements in which past due payments are paid back when exiting forbearance, and that is a lump sum payment. And also 14% represented borrowers who did not make all their monthly payments and exited forbearance without a plan in place yet. Definitely do not do this. Reach out to your loan servicer to discuss options to pay back all your missed payments, because you do have a lot of options, especially if you have a federally backed mortgage. In addition, about 8% resulted in a loan modification or a trial loan mod. And this is an option that would be your last resort, in my opinion, because this may negatively impact your credit. And just under 8% resulted in loans paid off through either a refi or selling their house. All right, changing gears slightly, I want to talk about a new report from Black Knight because they reported some mortgage delinquency numbers for the nation. They also announced which states have the highest and lowest mortgage delinquency rates, and I'll share that with you in just a little bit. Overall, Black Knight reported that mortgage delinquencies rose for the first time in 9 months, and this increase was primarily seen in early stage delinquencies, which are less than 90 days late, while the number of loans 90 or more days past due saw a modest decline. On the other hand, foreclosure activity hit an all-time low, and that's no big surprise given that we have a foreclosure moratorium in place right now. All right, let me first share the top 5 states that have the highest mortgage delinquency rates. Leading the pack was Mississippi, followed by Louisiana, Hawaii, Oklahoma, and Maryland, all with delinquency rates over 8%. The good news is that each of these 5 states had delinquency rates below their all-time peak or high. Now take a look at Mississippi, for example. Their February rate of delinquency is 10.79%. However, their peak was set in October 2005 with a sky-high rate of 23%, so that's more than 2 times as high as current rates. However, their all-time low of 5.56% is about half their current rate, so there's a lot of room for improvement. On the flip side, the top 5 states that had the lowest non-current rates were Oregon, Utah, Washington, Colorado, and with Idaho experiencing the lowest rate of only 3.29%, and that's down from their peak of 10.59% that was set in January 2010. And the big news that hit today was that the CDC extended the eviction ban through June 30th, which is an additional 3-month extension. On their website, it states that this was done to prevent the further spread of COVID. This extension is very timely because the previous ban on evictions was set to expire at the end of March. And to give you a very quick mortgage interest rate update, the average 30-year fixed rate mortgage, according to Mortgage News Daily, increased very slightly to 3.37%. If you enjoyed watching this video, please hit the like button and also consider subscribing as well. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day and look forward to seeing you on the next video.